You're not imagining it. Something big is shifting beneath the surface of the markets. While headlines scream about inflation, interest rates, and political drama, another story is unfolding quietly. A story that decides who gets richer and who's left behind. Most people never see it. They think the market is random. They chase news, hype, and quick profits. But behind the noise, there's a blueprint. A blueprint designed by people who understand one thing. Money doesn't just move randomly. It moves because someone wants it to. And when it moves, it doesn't trickle down. It flows up, to those who planned ahead. Right now, a handful of players are setting the stage for the next decade. They're preparing for booms, for busts, for chaos. They don't care if the market crashes, they're ready to profit from it. While everyone else panics, they stay calm. They're not smarter than you. They're just better prepared. And today, we're going to talk about how the financial elite are shifting their money and how you can follow the clues they leave behind. Because there's no reason you should be stuck on the sidelines, not when the biggest transfer of wealth in our lifetimes is unfolding. So the question is simple: will you keep reacting to the noise, or will you start thinking like the people who write the script? Let's find out. The real game isn't in the headlines, it's in the shadows. And that's exactly where we're going next. Because news headlines are designed to keep your eyes glued to the screen. They scream about fear or promise easy riches. Either way, they're distractions. They're meant to trigger your emotions. Fear of missing out, fear of losing everything. But here's the truth. Wealth isn't built by reacting to headlines. It's built by understanding what's behind them. Let's talk about why the headlines often lie. When inflation hit the US, news outlets said the economy was doomed. People rushed to sell stocks, but markets rebounded hard. Why? Because big players were buying the dip. When tech layoffs dominated the news, people said the economy was collapsing. But corporate profits stayed high, because cost-cutting boosted margins. The news said real estate would crash, but home prices in many cities held firm, because supply stayed tight and cash buyers stepped in. These are not accidents, they're signals. And if you only watch headlines, you'll miss them. Here's another reason headlines distort reality. They focus on today, they ignore the bigger trend. Last year, everyone screamed that high interest rates would crush stocks. Yet the S&P 500 roared back because money flowed in from all over the world. People think the market moves because of logic, but it moves because of money flow. And money doesn't follow headlines, it follows opportunity. Most retail investors get caught up in short-term noise. They watch prices tick up and down. They stress over every headline. But the people who get rich think longer term. They wait for the right moment. They buy when no one else wants to. They sell when everyone else is excited. They don't guess, they prepare, and they act only when the odds are in their favor. So ask yourself, are you investing based on your plan, or on what the news tells you to feel today? Because the real moves are being made quietly. And if you're not looking in the right place, you'll miss them. But what if the real game is happening else? Look at how the financial elite move their money. They don't chase headlines, they shape them. When the Federal Reserve raises interest rates, it's not just about fighting inflation, it's about shifting money across borders. Let's keep it simple. Imagine you're in Europe. Your bank pays you 1% interest on your savings, but US banks are paying 5%. What would you do? You'd move your euros into dollars and put your money in a US bank. That's exactly what happened. Trillions of dollars rushed into the United States. The dollar surged. Foreign currencies like the yen and euro fell. Suddenly, American investors could buy foreign assets at a discount. A property in Europe that cost $1 million before now costs $700,000. That's a 30% discount without negotiating a single price. American funds bought up European companies. They bought land. They bought banks. They found their wealth drained away because profits flowed back to US investors. It's a wealth transfer hidden behind currency moves. Now look at emerging markets. Countries like Indonesia have valuable resources: nickel, copper, rare earth metals. When their currencies drop, American investors swoop in. They buy mines. They secure resources for future industries like electric cars. While locals struggle with rising prices, this isn't new. It's how power has worked for centuries. Financial elites turn crises into shopping sprees. They buy low when everyone else is afraid, then sell high when the world calms down. Think about Turkey. Years of political chaos, debt problems, inflation out of control. American financiers lent them money, but the loans came with strings. Turkey had to pledge assets as collateral. Energy companies, transportation hubs, banks. When Turkey couldn't pay, those assets changed hands. Now Western investors and the people pay higher prices for essentials. It's the same pattern. Economic fear, currency devaluation. Assets bought cheap, profits flow back home. It happened in Japan too. The yen fell hard. Japanese assets became bargains. Buffett noticed. He bought stakes in major Japanese companies. He borrowed money in Japan at low rates to fund those purchases. Now he's one of the biggest foreign investors in Japan, and if Japan recovers, he stands to make billions. This isn't random luck, it's a plan. So next time you hear about interest rates rising or currencies crashing, ask yourself, who's getting ready to go shopping? Because someone always is. Markets can fool you. They look strong one day, then collapse the next. That's because what you see isn't always real. Let's talk about the illusion of recovery. During the pandemic, many companies seemed to be thriving. Stock prices went up. CEOs bragged about record profits. But dig deeper, a lot of those profits came from government support, cheap loans, stimulus checks flooding the economy, and massive debt. Corporations borrowed billions at almost zero interest. They didn't always use that money to build better products. Instead, they bought back their own shares. That pushes the stock price higher. It makes the company look successful. Even if business is weak, take a company making $2 per share. If they buy back shares, the earnings per share might rise to $3. But it's the same total profit, just divided among fewer shares. So the headline looks good, but the business hasn't. People see rising stock prices and think it's safe. They pour in money, only to find the floor disappears when the real numbers come out. Think about 2021. Tech stocks soared. Everyone wanted in, but many companies weren't making real profits. Some were losing billions. When rates went up, the party ended. Prices fell fast. Investors got crushed. This happens over and over. Housing, tech, crypto. 1 minute prices explode. The next minute they collapse because the illusion shatters. That's why you can't trust short-term spikes or glowing financial reports. Numbers can be massaged. Earnings can be made to look strong. Debt can be hidden. Cash flow can be manipulated. The headlines won't tell you this, but the financial elite know. They create the illusion and sell into the hype, while retail investors rush in, only to get stuck when the market drops. So ask yourself, if a company looks too good to be true, because the next crash will expose who's been swimming naked. The safe place isn't always where people expect. Sometimes it's not even in your own country. Let's look at the global chessboard. Money doesn't care about borders. It flows where it sees the best chance to grow. Buffett knows this. That's why he went big into Japan. Most investors ignored Japan for years. They said its economy was stagnant, its population was shrinking. But Buffett looked deeper. He saw companies with strong cash flow, low debt, and assets priced cheap because of a weak yen. So he started buying, and he borrowed money in Japan at low interest rates to do it. If the yen strengthens, his gains explode. If Japanese stocks rise, he wins again. Meanwhile, many US investors stayed home, focused only on American stocks, and missed opportunities abroad. Europe is another piece of the puzzle. It's been through crises, debt problems, political tensions, war in Ukraine shaking confidence. The euro dropped in value. American funds started buying European real estate, businesses, energy infrastructure, because they knew the panic wouldn't last forever. Once stability returns, those assets could soar in value. Emerging markets are another story. Indonesia has the world's biggest nickel reserves. Nickel is key for electric car batteries. When Indonesia's currency fell, US investors moved fast. They secured mines and supply deals, while locals struggled with inflation. This is how wealth shifts silently. One nation's crisis becomes another's bargain. Think back to the early 2000s. China joined the global economy. Factories popped up overnight. Western companies invested billions. Now China is pulling back. Tensions are rising with the US. That means new opportunities will appear elsewhere. Vietnam, India, Indonesia, countries poised to grab manufacturing from China. Investors who see this early will profit, because money follows production. Jobs. It happened after World War II. Europe was in ruins. The US helped rebuild. American companies invested overseas. Decades later, Europe was booming. New fortunes were made. History repeats. This time, money is shifting from China to new hubs. From strong dollars to cheap assets abroad. But not everyone notices. Most people only see their own backyard. They ignore the world stage. So ask yourself, are you looking beyond your borders or missing the next big wave? Let's talk about the mindset that sets smart investors apart. It's not secret knowledge or special connections. It's how they think and how they act. Smart investors don't gamble. They prepare. They know that money is made before the trade happens, not during the chaos. Look at the casino. People show up hoping to get lucky, but the house always wins in the end, because the house controls the odds. Investing works the same way. You don't win by guessing where prices go next week. You win by waiting for the odds to tilt in your favor. And you avoid big bets when you're unsure. That's why Buffett says rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. Because protecting your money matters more than chasing quick profits. Think about this. If you lose 50% of your money, you have to double it just to get back to even. That's why smart investors, they'd rather miss a small gain than suffer a big loss. Smart investors study where the big money flows. They track interest rates. They watch currency moves. They read balance sheets. They don't care about headlines or social media hype. They know the real clues are hidden in financial data and in how the elite position their money. Here's a simple example. A friend of mine bought a stock because it was popular online. It doubled in 2 months. He felt unstoppable, so he put in more money. Then it crashed. He lost everything he'd made, and more. He didn't look at earnings, or debt, or who was selling shares. He just followed the crowd. That's not investing. That's gambling. Real investors think in probabilities. They ask questions like, is this company making money? Are insiders buying shares? Is the industry growing? Is the asset undervalued compared to history? If the answers are strong, they act. If not, they wait. They want action, but action without good odds leads to losses. Patience creates opportunities, because markets always swing between fear and greed. Prices go too high, then too low. Smart investors wait for those extremes. They buy when others are afraid, they sell when others are greedy, and they stay quiet in between. So ask yourself, are you trying to get rich fast? Or are you planning to get rich slowly and safely? Because wealth comes to those who wait for the last piece is knowing where the money will flow next. Because that's where the biggest gains hide. Look at what might happen in the next few years. Interest rates could fall again. Governments might print more money. Markets could crash or explode higher. No one can predict the exact day, but we can spot the likely paths. If rates fall, cheap money returns. Stocks could surge. Real estate could boom. Commodities might rise. If markets crash first, elite investors will buy assets at fire sale prices. They're waiting with cash. Just like after 2008, just like after the pandemic crash. History repeats. So where might the money go next? One place is energy. The world needs power, oil, natural gas, renewables, even nuclear. Energy crises push prices up, and governments throw billions into new projects. Another place is technology, but not just social media or apps. Think artificial intelligence, semiconductors, cybersecurity, data centers. And they need massive investment. Healthcare is another sector. Populations are aging. Spending is rising. New treatments and biotech innovations keep emerging. Smart money watches these trends. They don't care if stocks drop short term. They focus on 5 or 10 years ahead. Geography matters too. Japan is becoming attractive because of a cheap yen and strong companies. Europe looks cheap after years of crisis. India and Vietnam are rising as manufacturing shifts away from China. Indonesia is critical for minerals like nickel. These places might see huge inflows of money because global investors want safety, growth, and bargains, but they want political stability too. So smart investors check the risks, currency swings, government policies, trade conflicts. All of this shapes where big money will go. The key is to watch the clues, follow the big funds, study what people like Buffett are doing. Check which industries are getting new government, because the next big wave will come fast, and those who spot it early will ride it higher. Here's how you... Let's talk about your action plan, because knowing all this is useless if you don't act. You need a clear strategy. So here's how you build your own passive path. First, decide your goal. Do you want to preserve wealth, grow it slowly, or take calculated risks for bigger gains? Write it down. Next, keep cash ready. Cash isn't wasted, it's ammunition. When markets crash, cash lets you buy cheap assets. Don't keep it all in one currency. Hold dollars, hold yen, hold euros if you can. This protects you if one currency loses value. Then watch interest rates. If rates start falling, assets like stocks and real estate might surge again. Be ready to buy quality companies. or funds tracking entire markets. Focus on businesses making real profits, low debt, stable cash flow, and not overpriced compared to history. Check if insiders are buying shares. That's a strong signal they believe in the future. Diversify globally. Don't bet everything on the US. Emerging markets like Vietnam or Indonesia. These places might grow faster in the next decade, but research political risks and currency moves. Don't ignore commodities. Energy, copper, nickel, these are crucial for technology and infrastructure. They might surge if supply stays tight. Think about gold too. It can protect you during crises, but don't go all in. A small slice of your portfolio is enough. Avoid huge bets on hype. Be skeptical of get-rich-quick trends. If an asset has no real cash flow, be careful. If prices only go up because others hope to sell higher, step back. Track the big players. Funds with billions under management leave footprints. Follow where their money goes. That's how you spot the next opportunity. Have patience. Most investors fail because they can't wait. They jump in and out, losing money on fees and bad timing. Pick your targets. Set alerts for prices you're willing to pay. Then wait. This is how Buffett built wealth. And it's how you can too. Keep learning, read financial reports, listen to earnings calls, understand how companies make money, ignore rumors, and keep your emotions calm. This is the passive path. A journey of building wealth slowly, quietly, and safely. Because the world will keep changing, currencies will swing, markets will crash and rally, but opportunities never stop appearing. It's up to you to be ready, so take control, make your plan, and start building the future you deserve. If you found this valuable, hit like, subscribe for more insights, and share your thoughts in the comments. Because wealth is a path we walk together. This is the passive path. Stay sharp. We've covered a lot today. You've seen how headlines can mislead you, how the financial elite move money around the world, how market surges might be illusions, and how global shifts create new opportunities. Now it's your turn to think bigger, to stay patient, to follow the money, not the noise. Wealth isn't built overnight. It's built by learning, by planning, and by acting when the odds are in your favor. I hope this gave you new ideas for your own passive path. If you found this helpful, hit like, subscribe for more insights like this, leave a comment, and let me know your thoughts, and share this video with someone you care about. I wish you good luck on your journey. Feel free to watch other videos here.